Bill Ackman, the head of Pershing Square Capital, recently released his 13F filings for Q4 of 2024 and disclosed what companies he is buying and selling. Today I'll be discussing a position that he has now bought in the last 3 quarters, which is Brookfield Corporation, and this is a position I've also been adding quite heavily to in my stocks and shares ISA I hold on Trading 212. So I'll be diving into this filing, reasons I believe he is still adding to this position, despite it being one of the biggest in his portfolio now, and whether Brookfield is a buy at current levels. If you get something out of this video, then leave a like and consider subscribing to the channel to help it grow. So this is how his portfolio currently looks. Now it doesn't include everything. Dataroma doesn't include the likes of the Uber buy, which was considerable and we talked about last quarter. Personally, I thought that was a really good buy. I really like how it's growing and I think it'll do very well for Bill. But I want to talk about his other trades because I do think they are significant. One in particular, Brookfield Corporation, a position I've been adding to quite heavily. He's been buying as well. He's now got over 15% of his portfolio in Brookfield. Just this particular portfolio, not including his other positions. Universal Music is still his biggest sort of holding at around 30%, although it's probably dropped down considerably since then. And Uber is up there as well alongside Brookfield. But Brookfield is a considerable size in his weighting and he's added about 6.5% in the last quarter to this position. Now if we look at the activity overall, we can see that a few things stand out about these sort of buys and sells he's been doing. Overall, in the last quarter, Q4 of 2024, he was a net seller of stocks. He only added around about 3% of his portfolio to 3 different positions, and he sold out of 2 positions to Chipotle and Hilton, and generally sold around about 5% of his overall portfolio, just over that. So he didn't actually add more than he was actually selling this quarter. And that seems to be his MO. He sells out of both Chipotle and Hilton worldwide. Hilton Worldwide was his largest holding for a while. It sort of keeps receding. He keeps selling different parts of it and trimming more. He's trimmed a considerable amount, over 4% this quarter. And in the last 3 quarters, we could see he has added to Brookfield. In Q2 of 2024, he added around 6.8 million shares at 2.7% of his overall portfolio. Last quarter in Q3 of 2024, he added massively, added over 10% to his Brookfield position, making it one of his largest holding. And then now he's recently added about 1% to the position. So not a massive increase, but still an increase, still showing his commitment to Brookfield Corporation. Now he's bought into other positions in the portfolio, but this one is still significant. He's been adding to it considerably despite it being up around about 51% over the past year. And he was buying around about $50 to $55 range. So he added considerably around that range, and since then the price is up to around $61 per share. So we can talk about maybe why he has such high conviction despite the stock being up so much. So Bill Ackman's connection to Brookfield actually dates back over a decade, as it says here. It stems from their collaboration on a restructuring of a bankrupt mall loan, which was General Growth Properties, a landmark investment for Pershing Square Capital. And despite occasional disagreements, Ackman expresses his respect for the CEO, Bruce Flatt, of Brookfield. Now, to me, in the past, when I've watched interviews with Ackman talking about Bruce Flatt, he's discussed him quite positively. When he refers to these sort of disagreements that it mentions here, it was about how to allocate capital and stuff like that. Bruce Flatt is used to having the last say. He's used to running his company and aspects of Brookfield Corporation his own way. Bill Ackman is also very vocal on the likes of X and other that when he doesn't like things. So I think that's probably just a difference of opinion, but it seems like they've moved past that and Bill Ackman has actually made billions of pounds going into Brookfield Corporation. Just below this here, we can talk about maybe the reasons why Bill Ackman's actually bought into this position. So as it says here, Pershing Square Capital Charles Korn believes the stock still has substantial growth, with shares expected to more than double in the coming years. So they expect Brookfield Corporation to double from this point. And Ackman has noted in the past that Brookfield trades at a value multiple of around 15 times earnings. Now, this is compared to other competitors like KKR, which is 27 times, and Apollo Global, which is 22 times, indicating a significant upside potential. So that's actually a very good point. If we think about it from a perspective of looking at competitors, which is a good way of analysing stocks, they're saying that the competitors for Brookfield, which are also alternative asset managers, are trading at a lot higher multiples. And Brookfield Corporation is expected to grow. Its growth is supposed to be quicker than these two, both KKR and Apollo Global. So I think that's significant to me. And that's probably why one of the reasons I've actually invested in this company. And it's pointed out very clearly here. I don't believe it's now trading at 15 times distributable earnings, which is their metric. I believe it's trading a little bit higher than that. But I still think it's a very good price for the current growth rate. Now, we know that he likes the valuation then against its competitors, but another thing that I think that he's probably very much keen on, and something I'm very keen on as a shareholder, is their track record. So how they've done in the past, because it evidences how they might be able to perform in the future, especially with an alternative asset management company, a company that builds its reputation and relies on that for investments. In this particular case, we've got their I think this is 2024. They was talking about, and this was one of their first slides in their presentation. And this is basically how they've competitively performed against big companies and the market overall. In the past 30 years, they've returned 18%, 25 years, 19%, and 20 years, a 16% annualized return. And this is comparative to other companies. So they've beat LVMH and Berkshire Hathaway completely on the last 30, 25 and 20 years, along with Walmart, as well as the S&P 500. The only one that they've underperformed in the past 20 years is Amazon. And if we look on a compounded return growth rate in the past 30 years, they've massively outperformed. Returning around about 13,873% compared to all these others, which are obviously considerably lower. We should always take these metrics and these sort of presentations with a pinch of salt, because they come from someone who has a vested interest in you believing they've done well. But I haven't seen anything like this from another company. I haven't seen another company compare themselves to the likes of Amazon, LVMH, Berkshire Hathaway and Walmart, as well as the S&P 500, and show they've come out on top over the long term. So a company that can do that arguably should be given the benefit of the doubt. Now, if we look at their most recent shareholder letter, I've highlighted a few things that I think are significant and are of value to shareholders in terms of just quick looks. So they recently reported they had a very strong year in 2024 with record financials, etc. They talked about their asset management business growing with new inflows and how they become a top tier insurance firm through their wealth solutions business. But one of the key things that I want to take away from this initial report here is it says our access to capital remains strong. During the year, we financed approximately 135 billion of debt across the business. We've also accelerated share buybacks and repurchases approximately 1 billion of common shares in 2024. So they bought back $1 billion worth of common shares in 2024, which is not new. Okay, so companies do this all the time, share buybacks, the likes of Visa and stuff like that. That's not new. It's returning shareholder value. But they talk about it in a lot more of a way where we can actually appreciate those share buybacks. They are only buying back their shares because they believe they're undervalued. Bruce Flatt has talked about this before. He only opportunistically buys back shares. If Brookfield Corporation, a bit similar to Berkshire, if they believe that their shares are overvalued, they wouldn't be buying them back. So I think it's significant that they've bought such a big amount over the past 2024, and they've then said this will continue into 2025. So it says that this is continued into 2025, adding further to intrinsic value per share for the company. To date, we've actually purchased around about 200 million shares, and as a result of the purchases in the last 12 months, shareholders now own around 1.5% more of the assets than they did before. So essentially, what they're saying is that they're buying back shares and they're not slowing down in 2025, arguably saying that the company still believe that its overall value of its shares are still looking good. And they actually address this intrinsic value of their shares and give us an estimate in this shareholder letter. So they say here, our stock price performance was very strong in 2024, increasing by around 55%. More importantly, our ability to consistently generate attractive investment returns has led to a continued growth of our intrinsic value. Our intrinsic value of each share increased by $15 in 2024. So what they're saying here is that their intrinsic value, by their estimates, have grown to around $100. And it's increased by $15 in 2024. But their overall share price increased by 55%. So overall, they're arguing that they didn't actually grow their own intrinsic value by 55% in 2024. But the share price appreciated more than that. And I think this is significant because no company that I've seen in recent times talks about, firstly, their intrinsic value overall. They talk about the story surrounding their stocks, their future forms of growth. They rarely talk about their own valuation. And in this particular case, they're actually given a rough estimate of $100 per share compared to the market value of $60 a share. Now, obviously, it's in their best interest to give an intrinsic value above the share price to reinforce people to continue to buy. But they're also pointing out that the share price has gone up more. So they're saying that the share price is increasing quicker than they are growing intrinsic value. So they're saying that the gap between the share price the market deems for this business and the overall intrinsic value of the company is decreasing. It's getting smaller. So is that likely to happen in 2025? We don't know. But we are saying here that they believe their shares are still undervalued, and that's why they're buying back more. Now, if we look at the guidance for the next 5 years, Brookfield has said that they will grow their distributable earnings by 17% for the next 5 years. So that's before carried interest, before realizations. They say they're going to grow it at 17% CAGR in 2029. And I think this is significant because we can actually see what they've guided for in the past and see how they've performed against it. So here we have their guidance on just growth of distributable earnings from 2020 all the way to 2024. Now, in the green sort of marker, we have what they've achieved, and the blue is what they actually gave in terms of guidance. So we can see that they actually largely beat or hit their estimates in distributable earnings growth before realizations. Now it's grown to around $17 billion and it grown at an 18% CAGR. And now they're saying they're going to grow it at the next 17% for the next 5 years. So when management can evidence the fact that they gave very accurate guidance 5 years ago, and they're now saying over the next 5 they're going to get a 17% CAGR, I'm inclined to believe them. But stepping back to what they've guided for and where this growth is coming from, distributable earnings is essentially their form of free cash flow. And as we can see here, distributable earnings before realizations and capital allocation is supposed to sit at around about $6.33 per share in 2029. And then they've got this other section here, which is 25% growth CAGR. Now this is actually distributable earnings after realizations, after capital allocation. So we've got two things here, the purple and the orange, which are actually accounting for this level of carried interest or growth. So we've got realized carried interest and capital allocation. So they're saying that their shares will definitely grow by 17% with no other help from realized carried interest or capital allocation. For perspective's sake, realized carried interest, this orange section here, is when they are managing assets and they do better than they actually said they would or have returned more to shareholders. They get a 20% stake in a business sort of profits if it goes over a certain threshold. I think it's 15%. So this little section here, realized carried interest, comes from them doing very well with their investments. It benefits their shareholders and their investment firms, and it benefits Brookfield because they can use that cash and reinvest it back into the company, which is what they do. So I think this is significant because it shows that realised carried interest, or really just realised gains, And capital allocation, which is basically just better resourcing of money, will have an impact that they believe will increase the overall returns to shareholders to close to about 25%, which is interesting because we're now getting guidance between 17 to 25% in overall returns. So now we've established that they're growing between 17 to 22 or 25% over the next 5 years by their guided estimates. We're going to try and predict what price to buy them at now. So we're just using a DCF calculator here for Brookfield Corporation. We've put in the metric of 4,900, which is essentially 4.9 billion. And essentially that's what they just produced in annualized free cash flow or distributable earnings. So this is how much they produced in 2024, as we've just got that figure. And then we're going to try and give an appropriate growth rate. So I would say they're going to grow by around about 20%. That's above their 17% growth rate, but still hedging against any sort of potential pitfalls or problems they may get at reaching that 25% growth that they guided for with their likes of carried interest and stuff like that. I've guided for around a 2% shares outstanding growth rate, so a minus 2%, so we're taking away 2 shares each year. That's mainly through their buybacks and stuff like that. Last year they did 1.5%. I anticipate them doing around about that sort of range in the next 5 years. Growth rate, I've put 10% for dividend. I don't think it really matters that much. They grew it slightly quicker than that more recently, going to 9 cents, but yeah, I think this is a fine growth rate. And then a price ratio. I gave it a price to distributable earnings or free cash flow of 15. It's now currently sitting at around 19. So generally, I think this is quite a low baller. I think it's quite a conservative estimate and something that Brookfield could easily achieve. And that gives us an overall buy range and fair value of $77 and a CAGR about 15.48% from the current share price sitting around $60. So on this sort of valuation, I would consider it a buy. That's why I was buying quite recently at $55 when it went on a bit of a dip. And my shares overall are doing quite well at the moment, up by about 20%. So I'm not really too concerned about this current share price being overvalued. I think it is bordering undervaluation in my opinion and is worth a good buy right now, especially with the more recent updates in re-acceleration in distributable earnings. Now let's do a more positive outlook. Say that they do better than what we are saying for. So if we say 23% growth, still below their 5-year sort of expected distributable earnings growth, and they continue to buy back shares in the 2% range, and they trade for a multiple around 16 rather than 15, we get a CAGR of closer to about 20% and a fair value of $93, not far off the intrinsic value that they've given of $100. Now to me, it doesn't really matter that Brookfield Corporation give an intrinsic value that is different to the fair value that I've got here. The company are very intimately aware of their own business, more intimately aware than shareholders will be. So the market is always going to give a margin of safety to intrinsic values that are guided for by alternative asset management companies. How big that gap is probably based off the level of returns they achieve. In my particular case, I believe that Brookfield is very much in the space of around about 15 to 20% returns from this area, and I don't believe that's an unfair margin. A fair value of $77, I think it gives considerable margin of safety to the share price of $60 per share. So me personally, I think it's a good range to be buying. I can see why Bill Ackman is buying in between $55 to $60, and I am doing the same in my portfolio. But what do you guys think? Do you like this one? Let me know down below. And as always, thanks for watching. I appreciate it, and I'll catch you in the next one.